Hi, and thank you for watching. So, many Canadians currently have mortgages with extremely low fixed rates, which they managed to obtain during the peak of the pandemic. Many of these same Canadians have also had their non-mortgage debt load increase recently due to the increased cost of living. When current rates with lenders are about the same or lower than the rate of your existing mortgage, it often makes sense to break the mortgage with a refinance to consolidate non-mortgage debt. When available rates are lower than the rate of your existing mortgage, it comes down to simple math, since not only will refinancing into a lower rate save you money on your mortgage, but moving your high interest debt into your mortgage will save you money as well. But since rates are high at the moment, if you obtained a low fixed rate during the pandemic, you would be at a loss for breaking your mortgage, since you would be losing your low rate for a higher rate. Even if we were to take into account the savings of moving your high interest non-mortgage debt into the mortgage, you would still likely be at a loss. For example, rates are about 3% higher than they were during the pandemic, so for every $100,000 of mortgage, increasing your rate by 3% would cost you an additional $3,000 per year in interest. So, what options do you have to consolidate debt into your mortgage without having to break your mortgage? Some lenders offer second mortgages with the same low rates that they offer on first mortgages, as long as they are the lender on the first mortgage. So, for example, your current mortgage lender may offer you a second mortgage at today's rates as long as they remain the lender of your first mortgage. The reason both mortgages have to be with the same lender in order to get the low rate second is because lending a second mortgage behind another lender's first can pose a higher risk to the lender in the case that the mortgage goes into default compared with being the only lender on the property. So let's say, for example, that you have about $40,000 in non-mortgage debt at an average rate of 15%, and your lender offers you a low rate second at 5%. Consolidating the debt into the lower rate of 5% would save you $4,000 per year in interest. This would mean that the low rate second would be a great idea even though mortgage rates are high at the moment, because this option allows you to keep your existing mortgage. But not all lenders offer low rate second mortgages, and instead may offer a blend and increase. A blended rate occurs when two separate rates and balances are blended together proportionally to create one new rate and balance. With a blended rate, you retain the same interest rate on the amount owing prior to the blend, and because of this, you are not technically breaking the mortgage, so no penalty is charged. The formula for the calculation for a blended rate is below, but in modern times we use blended rate calculators to do the work for us. These calculators can be found online. Let's go over an example of a blended rate. Let's say you currently have a mortgage of $300,000 at a rate of 2%. You would like to increase the mortgage by $50,000 to consolidate your non-mortgage debt. The lender offers you a rate of 5% on the new money of $50,000 to be added. The blended rate in this case would be 2.429% with a new balance of $350,000. So increasing the mortgage in this case only raised your overall interest rate by 0.429% rather than by 3% that you would be facing if you broke the current mortgage for a new one. With a blended rate, the maturity date of your mortgage does not change, so let's say you have 3 years left in your current term. In this case, the rate which would be offered on the new money would be the lender's lowest 3-year rate. Adding money to your mortgage with a blend and increase or a low rate second is not just for consolidating debt, it can be used for renovations, investment, or any other purpose. A blended rate can also be offered for a purchase when you are selling your current home and buying another. This is called a port blend and increase, which works exactly the same as the blended rate example above, but the mortgage is ported from the property being sold to the one being purchased. A port blend and increase is again a way of avoiding losing your low rate and having to pay a penalty to break your mortgage. In the case of a purchase, the new money being added is normally due to the purchase price being higher than the sale price, which means the buyer requires a larger mortgage than their current mortgage to buy the home. If you have any questions for me, please feel free to leave your questions in the comments section below or contact me via my website. Thank you again for watching.